So, all right. Happy Tuesday afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly whirlwind through all the latest news, get a glimpse inside the current business climate from the mortgage industry. And each week, I am pleased to be joined by one of our lender members as my co-host, back in the co-pilot seat for probably the fifth or sixth time. I don't think anybody's co-hosted more than you, Jodi. It's the president of Nationwide Mortgage Bankers, Jodi Hall. Jodi, good to see you.
Hi, Rich. Thank you for having me. And I think that maybe you shouldn't have me on here because I feel like the week leading up to me co-hosting with you is like the most dramatic week that has happened in a long time. And I hope that this is the height of the disruption, or I can't come back. I can't come back to the show and be a co-host.
Well, we're going to keep having you back, even if tumultuous events seem to follow your co-hosting slots. But you're right. I mean, I remember like a couple of the big pandemic related things that just happened with the mortgage industry. You were in the co-host slot, and this week, the day before you come on, we get the biggest negative market movement on rates in 10, 11 years. So, but all right, well, let's go ahead. Let's go ahead and get after it. Let's start with the elephant in the room, right? The number one topic for all mortgage lenders right now is this rate climate. Put even more in the spotlight this week because of a couple things. So one, we already mentioned a huge run up in rates, mortgage rates off the heels of Friday's inflation number, which was after a couple inflation numbers that were in line or even maybe a little bit more tepid than what the economists thought. This one was a little hotter, having the predicted reaction. Then you got, of course, the Fed is meeting as we speak right now. They make their policy statement tomorrow, Wednesday at 2 p.m. Eastern, and really fueling just a sell-off in mortgage bonds and an increase in mortgage rates. Yesterday was a piece in the Wall Street Journal that in all likelihood, the Fed leaked, basically saying that the Fed is now considering a 75 basis point hike, which nobody had really been talking about. I think the projections were 50 in June, 50 in July, but now it seems to reason after the Friday inflation number that we could be looking at 75 basis points tomorrow and another 75 in July.
Right. I think that it's interesting because we have talked before about emotional responses to what's going on in the industry. And I was thinking about this over the weekend because, we have seen this time, the last we saw it was probably the worst was 2008. And even then, social media wasn't a thing. So I think like it's all of these cycles are sped up from communication. But I think the biggest point with no one has confidence the Fed is going to be able to get inflation under control. They admitted to having mistakes and not raising the rates last year. And maybe we wouldn't be in like the double whammy situation with the war in Ukraine and not dealing with inflation soon enough. But it was 2008 was the last time that the bids stopped on mortgage-backed securities, and it stopped in the subprime market earlier than that, but across the board, stopping on the bid of mortgage-backed securities last happened in 2008. And I don't know if you all remember, but Bernanke ramped up the purchase of mortgage-backed securities. And is it a coincidence that the Feds this year said that they were going to taper off and allow the more MBSs to be able to sell off, and potentially in threatening, to sell off? So, it's like, is that a coincidence? I just think that the market in general we're not confident that we will get out of these inflationary areas soon enough. And it's not shocking that the Fed leaked a 75 basis points increase. I mean, that it just is, it almost seems par for the course, that it seems like a comedy of errors, lack of being proactive in the market and thinking ahead. It's like, pull this lever, see if this works. Oh, that's not working, so let's pull the lever further. Oh, wait, let's push the lever back. So it feels like they're trying to find their way. But I also think that that's compounded by our accessibility to information in real time.
Absolutely. Many astute points. One being the Fed may be running an old playbook against a new problem. Yep. And and the market's really complete lack of confidence in this point at the Fed. All you got to do is take a look at the stock market, the bond market. It is just screaming that anybody that is investing money anywhere is doing so or not doing so in a way that they just feel like that the Fed does not have inflation under control. And to your latter point, why would they not feel that way? From the inflation is transitory, really up until it reminded me like how, like, with the more global pandemic, where I'll never forget, like on Friday, March 12th of 2020, the flu was worse. And then Friday, March 13th, it was like, all right, we're shutting the world down. And right. The Fed with inflation, they were like literally still screaming transitory until really the day before they said, oh, you know what, we misjudged this. Right. And now, almost certainly leaking to the Wall Street Journal the day before their policy meeting starts, a change in their policy. Man, what's better to do? This Fed has really gone out of their way to telegraph things to the market, like almost to a fault. And now they're adopting their policy so haphazardly and reactionary that their mode of doing that is now leaking stories the day before their meeting starts.
Right. And we talk about, the investors' lack of confidence. They should have been, all of investors of mortgage-backed securities had been more on point and had known to not have confidence. So it would play out in a shorter period of time instead of all of a sudden. But what we're starting to see is that's leaking over to the home buyer confidence, right? We saw mortgage applications were down 6.5% last week over the previous week. And I believe, last year we talked about historically high assets, right? Home buyers had more assets than they ever had before because they had been sitting at home doing absolutely nothing. And now it's like, even if they do have a nest egg, you want to sit on that nest egg because you don't know if, with gas prices being, it seems like gas prices are almost keeping up with mortgage interest rates, right? So we've doubled interest rates from January till now, have essentially doubled. We've seen almost the same thing with gas prices, but when borrowers see that it's costing 10% more at the grocery store, it's, gas is over $5 across the United States on average. And people are really starting to have that doom and gloom emotional reaction. Like, I don't want to buy a home. And I think that, we're seeing that now. Hopefully our cycle out of it is as fast as our cycle into it, so that there will be a positive end. And I think we saw that a little bit. You sent over an article about the fall market and the positive news of the fall market.
Yeah, Realtor.com revised their 2022 projections. And, essentially what they're saying in these revised projections is buckle up for a slow summer because all the reasons you mentioned, tired home buyers, right? News is delivered to human beings so much different than the way it was when we were younger, right? If you wanted the news, you would walk into the driveway and grab the newspaper and consume it. If you didn't want it, you didn't get it. But now everybody's doing a much better job feeding us the news if we want it or we don't in very sly ways. So you're tired home buyers, right? Rates are up. You hear it everywhere. Rates are the highest they've been and blah, 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 blah. Home values up 30% last 2 years. And people are just like, I'm ready to stop looking at homes for a little bit because I'm a little tired.
Yeah, I definitely think that, people are at a place that if I can afford the position that I'm in related to housing and keep food on the table and pay for gas to go to work, I'm going to hold tight. I'm going to reduce spending. I'm going to increase cash flow, and we'll see how long that sustains. But there's a number of reasons about why home buyers are going to be on the market. There aren't rent caps in a lot of markets, and people are, getting the phone call from their landlords to, if they want to renew their lease and keep their family in their home, that's a $1,500 increase. So, it is, I think that people are willing to hold tight and see what happens and do nothing. So I think that that's what's going to cause the slowdown over the summer. And hopefully as home values stabilize and there are less than 25 bids on every single property that pops up on the market, hopefully that'll bring some more home buyers back to the market that we have experienced, prior to today.
Yeah, I think it could be a big fall. And that's kind of what realtor.com is projecting in their last, especially if rates were to come back down to say 4.5%. I think that it's crazy that I'm saying that here on June 14th. If man, rates could only come back down to 4.5%. Still a little surreal, but that's the market we're in right now. Yeah, almost like a shaking out of the housing market right now, like rates and values got to the point where, essentially buyers are like, hey, no mas, it's in theory should cause values to stabilize a little bit, more homes to be available on the market, a better home buying opportunity for people as we get into the fall months. So, but you're right, like the the cascading impact of inflation. I mean, like it hit yesterday after work. I went and got gas and got Chick-fil-A for 6 people. The gas was $100. Chick-fil-A was like $102. I'm like, yeah, I went to go get gas and fast food, and it cost $202. Like it really set in. So,
right. It is, it's crazy. So one of the topics we wanted to talk about was the decrease in demand in Nassau County and West Palm Beach, Florida. And this will relay into, I did some math. So Rich's comment was that luxury home sales in the US plunged the most since the start of the pandemic. And in Nassau County, New York, where close to the headquarters of Nationwide Mortgage Bankers, had the biggest decline, while high-end home sales in West Palm Beach, Florida, tumbled nearly 33%. So I did a little bit of research, and in Nassau County, home values have continued to rise, and the home sales are starting to decline. The median home sale price in Nassau County is $647. So if you put 20% down, your PITI payment at 6% is $3,103. Taxes are approximately 2.1%. There's $14,000 a year in taxes, $1,150 a month, $1,100 a month in insurance, and your payment is $5,353. The median home household income is $120,000. You take $120,000, you take out 30% for all of the taxes and deductions, and people are looking at having, I have a number here for you. I did the math and it was something like $1,700 left a month to pay for gas, to put food on the table, to do whatever. There's not a lot left there. So there's some pain. And then the luxury homes, the fall off of West Palm, New York. And so it was, I'm trying to think of the two, there were 2 states that a large percentage of people relocated to Florida, New York being one of them during the pandemic. And if you look at that, there is a decrease in what the property values are, but why not move to Florida? Even when home values were surging, why not? Because their median home price is $375,000. So if they can work remotely, continue to make $120,000 household income, why wouldn't you live someplace else in the United States, whether that's, West Palm Beach County, or if it is in Cleveland, Ohio? So it's with some interesting numbers when putting it together. But Rich, don't worry. While I was doing my research, I found that your second home is still on the market for $29.5 million. Oh, only 12,500 association dues per month. And it's a condo. It's a condo. Are you kidding me? Like, I have to live with people on each side of my walls and for 29.5 million.
30 mil should buy you, at least some space from
you should get a yard with that.
Yeah. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the president of Nationwide Mortgage Bankers, Jodi Hall. Jodi, you mentioned luxury home sales plummeting, biggest plummet in luxury home sales since the start of the pandemic. And I think one of the narratives, even through this tough market to start this year, has been the high end in America is still doing well. Homes that are coming in the market are largely higher priced homes, and they're still getting gobbled up immediately. Mm-hmm. And kind of like we saw geographically, areas like Idaho and some of these other areas of America that just Phoenix that just shot up, that you're starting to see some regression before the broader macro numbers indicate it. I think this is kind of like one of those things, right? Like the fact that even luxury home sales are really falling, probably, lends itself to say to what we were kind of talking about before. This could be like the summer slowdown that sets up for a little correction for everything going on in housing and rates and values that could set us up for a healthier path forward.
Yeah. And I think too, it's people are scared. It doesn't matter, if you have high net worth and can afford luxury second homes. It's stay put and try to build up your cash and sit on it to wait and see what's going to happen. So I think that we will continue to see that in the housing market where no one wants to put money in. Then hopefully when home values, start to decline, then everybody will be positioned to have a very healthy buying market.
Because people have memories of 07, 08. I mean, you remember this industry, even before the pandemic, 3-4 years ago, there were still, with some young people, I think it's eroded over time, obviously a little bit, but from some young people as recently as a few years ago, a negative stigma about buying a house, maybe because of something their parents were involved in 07, 08, the meltdown and everything that went along with that. I remember, being at, youth sports events in 2012, 13, like, what do you do for a living, or cocktail, like not being embarrassed to say I was in the mortgage industry, but, there was people that felt, the mortgage industry, like that kind of went away and lessened. And then you got into the pandemic. And I think one of the good things about the pandemic is it like emboldened the value of the home in America.
Yeah, for sure.
The importance of your home, your dwelling. But it wasn't that long ago where, so I think that, I feel like there's some of that in there too right now, like as far as this fatigue from potential home buyers right now. You don't want to be caught on the wrong end of a hot market. Like, remember 07, 08? I remember, I was working for a bank and we were doing a lot of construction business, and luckily we didn't get caught up in this a lot, but people were just walking away from half-built homes.
Yeah.
They were like building a house for like $600,000 down in Florida. And, the meltdown happened. Like, okay, now your home you're building is worth 400. They're like, I'm taking a bus to like Wyoming.
Yeah.
Go to the WIC section.
Yeah. I think the thing that is different in that. So I think people learned that lesson, right? Like, oh my goodness. Like, I looked at a second home in Kiowa Island, just like it was probably in 18. So same point. And I was looking at that same place. So it was like a condo that was on the ocean that was right by all the Kiowa golf courses. And it was for the unit that I stayed in was for sale for like $265,000. I looked that same one bedroom up just to see what was going on in the market. And it was 600 and some thousand. So I think that, right now people are scared. People aren't going to put cash out. But I think that also, again, because we live in a world of immediate information, I think that cycle will go away faster than it did prior to social media and instant information.
Yeah, and a lot different about this cycle, as you noted. I mean, the performance of mortgage loans is impeccable right now. And there is so much demand that I do believe the pandemic's had some impact on that even with the crazy run up in house prices, I expect a leveling off. Of course, it's long overdue probably, but I don't feel like we're going to have I just feel there is so much demand to buy housing. And the other part of it is, right, you got to live somewhere. Rents are up just as much as mortgage rates. And, you're not building wealth with renting. You're not, some people have to parts of their life, but so you got to live somewhere. So I do feel like we're going to come out of this strong, but it does feel like there's a little fatigue factor going on right now.
Yeah, for sure. So do we want to talk about the Equifax scoring real quick? Because I know
how's it impacted you? Has that impacted you at all? And talk to me about it.
I think that the impact came largely from the unknown. It took until, so this happened like in a period of time, what was it, like March 17th through April the 6th. And then the announcement comes out, and a couple of weeks later, we still don't have, it impacted 12% of scores, but we didn't have any information. So then on the 27th of May, they released the information to the credit providers. And in the meantime, we were reaching out to the agencies hey, what do you want us to do? And we were getting canned responses it's your responsibility to make sure that you qualify the borrower. So it was that independent mortgage banking feel. You feel like you're making decisions on an island with the least amount of information possible. So we did get the data from our providers at the end of last week, and it wasn't as bad as anticipated.
Oh, good.
Yeah, so we had about I don't know how many credit pulls we had in that time, but we had about, I want to say, around 85 to 90 impacted scores. The good news was a large percentage of them increased. So it wasn't half increased, but you wipe those all out. I'm like, we're not repulling credit, because if the other two scores go down and we lose a decision, or more importantly, lose a lock in this market, you're screwed. But for those that did, where the Equifax score did go down, we started analyzing each one of them. And in many cases, it was either not that borrower's score that was the middle score that we were using to qualify, or it wasn't, or even if it was our borrower, it was Equifax was the highest score that came down to a percentage where we were still using the TransUnion or still using the experience score to qualify. I think we ended up, and I need to finish this analysis today and get it out to everyone. I think we have about 6 loans that were impacted, but they're very early on in the stages. I don't even think that the loans are locked yet. So I feel like it was less detrimental than I had anticipated. I was really worried about, having loans that were locked that we were just getting trashed on, and, but it was much better than had anticipated. And we didn't really receive guidance from the credit providers or from the agencies. It was just kind of shooting from the hip. That's what we decided to do. Feel like it gives us the least amount of risk, and of course, loan officers want you to repull in those where the score went up, because they think they might get a better price, and it's that's dangerous.
Well, that's great to hear. Not surprising, the due diligence you've done on your end, and great to hear that the impact has not been what you thought. I thought this story would be a lot bigger news. I remember it coming out right before, I think, the show I did with Rob 2 Fridays ago, and you start to think about up to 12% of borrowers, the wrong credit scores for nearly a month, the potential impact of that, and borrowers paying more fees than they should have. But to your point, maybe, some of the FICO scores were too low, and they're actually better. And in other cases, maybe the Equifax score was not the one that was the needle mover. So
I'm glad that we didn't have like hundreds of thousands of scores impacted, and it's like we were exchanging emails leading up to this, and we were talking about like mortgage news has a life cycle, just like all other news has a life cycle. And it's that the Equifax issue got buried by 6%, approaching 6% interest rates, and the Fed's increasing. So I think that, the market, people are more worried about losing half of their net worth because of the stock market, rising interest rates, inflation, gas prices. Equifax, it was good timing for them in the mortgage news cycle for what they had.
Hey, I remember now, they released it. It was the Friday before Memorial Day weekend at 4 p.m. Eastern. You talk about
like no one cares. Like everybody's like, let's drink beer and have fun all weekend.
Like literally, if you go to a marketing person, like, listen, we got some horrible news, just some horrible news we've got to put out there publicly. Yep. When would you want to do it? The Friday before Memorial Day weekend, we're probably in the top 5 of all the times of the year.
So I told Rich and everyone, like, I always aim to try to have a positive on what is going on, no matter what it is. So for those of you who are connected to me on LinkedIn, I sent out a message. I reshared Rich's post about what we were speaking about, and I asked for positive comments. And guess what? None. So we're trying to figure out if my connection, like if I just like suck at social media and my connections, or if my connections suck. So if you're one of my connections, you should have commented, because I'm calling you out right now. So I had to put my own positives together. And my positives are, it isn't the 80s and we aren't at 13% interest rates. It isn't 2007 and the bubble hasn't burst. And it doesn't look like it's going to, at least in a very large percentage of markets. Underwriting turn times are at historic low turn times. So get your loans in, get them underwritten, and Cleveland baseball is back in the playoff hunt. So
the Guardians, we've won like 10 of 12. I love it.
I'm still calling it the Cleveland baseball team.
The Cleveland baseball team, the Tribe, the Indians, whatever you want to call them. Yeah, they are playing well, but great dose of positivity. Very true. And you always do bring a ray of light to, what has not always been the rosiest, set of topics to discuss with our industry, especially here in 2022. So, but yeah, a lot of good points. And as we've discussed all show and really for all year, it's a healthy climate for purchases of homes just going forward. As you mentioned, some historical perspective on where rates are at right now. There's a lot of demand to buy houses, and people are working on it. It's just people value the home more. And I really feel that's going to be a positive for our industry for a lot of years to come.
If unless you're an old school loan officer who has been through this, it's going to clear the path for the tenured loan officers, because if you got into the business in 2020 and you think that 2020 and 2021 is the norm, you're not going to make it. So I think that we will see, an overall stronger mortgage lending industry moving forward. And that's what realtors are talking about too. Like, hey, the old school realtors have been through this, and maybe there's too many realtors in the market they'll have to pivot to other things. So I think it's a good thing. It's a good thing. It has to happen. They say you have to prune the tree to get it to grow. So it's what's happening in the industry.
Agree completely. And Jodi, as always, really enjoy talking about the industry with you. Enjoy having you on as the co-host, evidenced by your multiple appearances here. So thank you very much, as always, for joining me.
Thank you for having me, and thank you for the TMC team and family for always being extremely supportive of what we do.
Likewise, and to all of our viewers, listeners, thank you very much for taking 30 minutes out of your week with us. For our podcast listeners, join us live Our biggest audience is the podcast audience. We do this program live every Tuesday at 2 p.m. Eastern. Go to mortgagecollaborative.com and our event calendar. You can register and you can find all of these episodes archived on our YouTube page as well. So until next Tuesday, have a great rest of the week, everyone. And Jodi, thanks again.
You're welcome. Thank you all. Have a great week.
Have a great week, everyone. Take care. Bye, Jodi.